Good afternoon, ladies and gentlemen. Welcome to Market Masters, our flagship show where we get you to meet the finest brains that there on Dalal Street. And today we have the pleasure of welcoming Mr. Hiren Ved. He's the co-founder and director, chief investment officer at Alchemy Capital Management Private Limited. Mr. Ved has a 34-year experience in capital markets and is often amongst the first port of call for anybody wanting to generate extra alpha in the market. Namaste Hirenji and a very warm welcome to you. Happy New Year. And it's something that a lot of people are now getting worried about. This is the fourth consecutive month of consistent and relentless selling that we are seeing. How do you see sentiment on Dalal Street at this moment, and what are you advising your ultra HNI clients?
So, good afternoon, Happy New Year to you and all the viewers. I think it's quite natural that investors would be worried given that the Nifty has corrected back to back for 4 months now. This doesn't happen too often. And I think that we are now reaching a stage in the markets where there is more fear, both known and unknown fears, rather than any sense of rationality, right? I mean, some level of correction in the markets always happens. It's not something which is new, but especially when you look at the way the markets have behaved in the last 1 week or so, I do get a feeling that there is a lot of fear in the minds of investors, and even the slightest of bad news is blown up significantly. So I think we are in that phase. Initially, there was an uncertainty regarding what Trump would do, with his trade policies. Obviously, we've seen a little bit of a slowdown in the economy and earnings. And there are the usual uncertainties around the budget. So all of these have, and then obviously we've seen relentless FI selling as well. So I think all of this put together has created some level of unease in the minds of the investors. And it is quite understandable if the market keeps falling the way it is falling. People would wonder कि ऐसा क्या हो गया market,
Ji. So ultimately, Hirenji, it boils down to picking stocks in the debris that is around us. Now, your ultra HNI client list, what are they trying to do? What are you advising them in the sense, how much of cash do you see in their portfolios? We have a lot of body of evidence where a lot of top end mutual funds which are larger schemes have anywhere between 13 to 22% cash on their assets. How are ultra HNIs placed in this comparison?
Look, I think, most of our investors let us take those judgment calls on what levels of cash we should be sitting or not sitting on. Because frankly, they give us the money that they have already allocated for long-term investing. We always communicate to our investors that the market's not a one-way street. There are things that happen, and we can only learn from our prior experiences, right? We have seen things like 2008, where there was a global financial crisis. We've seen COVID, which was like once in a century black swan event. And despite these very, significant events, we have seen markets come back up, right? Uh, Usually these corrections don't last beyond 1 or 2 quarters. I don't think we are anywhere close to those kind of a situation, frankly.
Yes,
So
sir.
I don't see any significant merit that the markets may continue to fall like this. I think there will come a point where stocks will get or are already getting quite attractive for a long-term investor. And all this cash that you talk about, I've seen this too often, that once the market starts to go up and the sentiment changes, then everybody will try to deploy the cash at the fastest rate possible because nobody wants to miss a trend. Until the markets are going down, you feel very comfortable. Oh, I have so much cash with me. And every day you feel, नहीं यार आज नहीं लेते हैं, कल लेते हैं, कल और सस्ता मिलेगा, right? So this
Yes.
has happened too often. And my sense is that I don't want to comment on what others are using this as a with their cash, but we are certainly slowly and steadily deploying any cash that we have, because I certainly feel that any levels significantly below 24,000 on the Nifty are fairly attractive at a broad level. Obviously, you have to pick the right stocks and sectors and so on and so forth. But we certainly believe that we are of the view that at nobody can pick the real bottom. Uh, but I do believe that this is a great time to start slowly and steadily deploying your cash in the market.
Wonderful. And the beauty of getting you, Mr. Ved, on the show is that you use fundamental research over long, long periods of time to pick out potential outperformers. Now, this deployment of cash that you talk about, where would that be sort of aimed at? We've seen the small cap and the mid cap index correct about 11 and 9% respectively so far in January alone. Over the last 3.5, 4 months, the losses have been to the magnitude of 15 to 17%. Where do you find value in this market?
So I think, I think that by and large, we haven't changed our focus in our portfolios from what we already have. So we are just currently adding to the same positions that we had, and maybe adding a couple of new positions in the market. For example, we do believe that there is decent value now coming in some of the large NBFCs, uh, where we think that credit costs have peaked. And I do believe that over the next few over the next few months, or in fact weeks, we should start seeing easing of financial conditions. I think we have the RBI uh, uh, policy meeting coming up immediately after the budget is presented. And we do believe that there is a lot of liquidity tightness currently. And, the RBI has been running a very tight monetary policy. So I think there will be some easing of this tight monetary policy that can happen, maybe either by a CRR cut or OMO, or a combination of combination of steps that the RBI can take. And once that happens and liquidity cools off, that would mean that the current tightness in the cost of funding for many of these NBFCs should ease. So that's one new area that we are investing in. Uh, Other than that, as I said, we continue to be bullish, on areas that have substantially corrected. For example, there has been a lot of worry about the capex scenario in India, given the fact that this year we've seen that government has not spent uh, up to the full capacity that they had budgeted for because of elections and various other reasons. But we have no doubt in our mind that eventually, we will see a rebound in capex. And therefore, we believe that many of these stocks have corrected maybe even 20, 25, 30%. And we like these companies from a long-term perspective, and we continue to add to our current positions in manufacturing, in capital goods, even in some of the consumer space, where we think that some very well-run consumer companies have corrected quite substantially from their all-time highs. So, we don't get deterred by short to medium term cycles. I mean, cycles are inevitable, but I think we're now coming to a point where a lot of the bad news is already in the price. And we think these are great entry points.
Yes, sir. Actually, Hirenji, there was this phase in the markets over the last 2.5 years where the index wouldn't correct anywhere beyond 5%. And everybody was so clued into buying the dip that they thought it would, always remain that way. And now we have this 12-13% dip on the Nifty, and people are really getting worried and questioning this broader thrust of the economy. I want to understand, according to you, are we in a structural slowdown, or is this a cyclical pullback? The reason why I ask you this is that a lot of economists are, coming up with this data that there is little or no job growth, there is little or no growth in commercial vehicle sales, entry level cars, bikes, so on and so forth. And the fact that personal consumption is way below even GDP growth. So
Correct.
essentially they are saying that there is no demand in the economy, and here is a market that has run up way ahead of fundamentals. Which side of the equation do you stand on?
Oh, I think, look, the one fact remains that by and large, post-COVID, consumption has not kept pace with nominal GDP. And, that continues to be the case if you look at many of the FMCG companies that have reported, or we are also seeing that now bank credit growth has substantially slowed down, right? And therefore consumption stocks haven't seen any significant growth, because really the consumer at the bottom end is being impacted by relatively low income growth coupled with high inflation. And also interest rates have remained quite elevated, and therefore EMIs are eating into any additional savings that may that may generally accrue to them. And therefore we are seeing a very slow bottoming out process, and consumption at the bottom end has not really been a driver of this economy. It's only the consumption at the upper end which has held up, right? And there also now we are seeing some moderation that would happen. I think what has happened post-COVID is that this government has really doubled down on capital investment and infrastructure spending, right? Because they believe that rather than stimulating artificial consumption, it is better to build productive assets. And the money and the GDP multiplier of spending on many of these infrastructure projects driven by government capex should actually drive long-term structural growth in the economy. But having said that, yes, there is now increasingly a clamor, that the government probably should do something about the very weak consumer sentiment and consumer spending, which has remained low for a long period of time. And that's also one of the reasons why many of these state level elections have seen success of, the schemes like Ladli Behna, etc., because it has really given relief to people at the bottom end of the pyramid.
Yes.
Now, whether we can continue to, economics is all about balancing priorities. You cannot ignore something, but at the same time, it's taken us a lot of hard work to get our fiscal in order. We know the perils of stimulating consumption by just giving away money. Because sooner or later this will come back as even higher inflation, and then there will be an even greater tax on the consumption of people at the bottom end. So I think the government has a tough situation on its hand, that on one hand you need to maintain a fiscal balance, and simultaneously you need to do something for people at the bottom end of the pyramid. And therefore people are looking at what additional steps would the government take in the budget. Every time the budget comes, there is always a clamor of reducing income tax at the lower end, increase the slabs for so on and so forth. um, there is always a clamor for cutting GST and so on and so forth. But I just feel that this, if you track the philosophy of this government, I think the philosophy of this government is that they do not want to unnecessarily stimulate demand by giveaways, right? They rather would spend their fiscal power on incentivizing production, on spending on infrastructure, and making India competitive. So let's see what happens. As I said, there are always pulls and pressures. And I think by and large, the government has been very disciplined about the fiscal. But maybe we could see some incremental steps being taken to help consumption at the bottom end. I think it just so happened in the last 6-8 months, we have been running an extraordinary tight fiscal policy because the government did not spend at the run rate which it was supposed to spend, and we also simultaneously had a very tight monetary policy. So I think that one of those, we need to loosen up a little bit to get the animal spirits back and to get consumption back in the economy.
Right.
And that will probably happen first with monetary policy rather than fiscal policy.
Right. And that brings to me to the next question, sir. We are four sessions away from the annual budget, and as you say, there has been a clamor from all parts of corporate India to do something to stimulate demand. We've seen the government spend very well over the last 8-9 years or so, but there is hardly any worthwhile corporate capex to talk about, whether brownfield or greenfield. If you remove telecom, if you remove hospitals, and maybe sectors such as cement and steel, what is preventing corporate India from spending at a time when they've made a lot of money by not increasing salaries and of course cleaning up their balance sheets because of paying off debt?
See, I think that, first of all, we need to understand that unlike in the previous cycle, which was the 2002-3 to 2008 or 10 cycle, where you had the private sector massively participating in many capital intensive industries, right?
Yes, sir.
People were building thermal power plants, people were doing BOT projects, they were willing to own infra assets, right? People were spending on cement, steel, all of this. In this cycle, it is relatively different. This cycle, I don't think that the private sector is not doing capex, but I think the nature of capex has changed, right? I think today the private sector does not want to own, very capital intensive assets, and therefore the government is building these assets. Most of the capex is happening in relatively, I would say, lighter capex areas, right? Renewable energy, where the private sector is definitely doing capex, or for that example, data centers, or uh, 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 wherever there has been uh, PLI schemes in electronic manufacturing, in semiconductors. I think these are areas where the private sector is spending money because the nature of capex is changing, and the heavy lifting that requires to be done is largely being done by the government. Now, there is also one thing that I would like to say is that when you mentioned rightly that the corporates have deleveraged their balance sheets, right? Which means that post COVID and post the IBC, you would have seen that lot of assets have changed hands. So, for example, companies like Ultratech or the Adani Group or JSW have bought lot of assets rather than building greenfield projects, right? So, for example, Tata Steel bought out Bhushan Steel. A lot of power assets which were standard were bought out by existing players. So I believe that one of the other reasons why private capex has not happened, because they have taken a buy versus build decision.
Right.
And if they were able to get many of these assets cheap from bankruptcy, courts, why would they build new assets, right? Because as a corporation, you will decide कि मैं नया कैपेसिटी ग्रीनफील्ड डालूं, या मुझे अगर कोई अच्छा existing asset I'm getting at, let's say, 50 cents to a dollar or 40 cents to a dollar, I would rather buy that asset. And we've seen solid consolidation that is continuously happening in the cement industry, for example. The
Yes.
big the big guys are buying out all the smaller capacity companies, right? So why would they, for example, they will do a combination of, maybe they'll put up some new greenfield plants, but a lot of incremental capacity is being bought out in the by buying out other companies, weaker companies, right? So I think that is how we need to look at capex. I don't think that any businessman in India will not do capex unless if he thinks that he's going to, by spending that money, he's going to see returns. I think that's the nature of capex in India has significantly changed. And also we've seen in the last couple of years what we now call a lot of the new age companies, right? Now, when they
Yes.
spend money, it's not capex, it's actually revenue expenditure, because they spend money on marketing, they spend money on people, they spend money on technology platforms, which is not really hard capex that we traditionally have been thinking about. So yes, one of the reasons, as I said, one is that the nature of capex has changed, and secondly, also in many heavy industries, existing strong players have bought out weak capacity, and rather than building new capacity, they have bought new capacity, and that's why we keep feeling कि private sector capex नहीं हो रहा है. It's not that. In my view, capex हो रहा है, but it's happening in completely different sectors than what we have traditionally seen.
And perhaps that is a sign of a maturing economy, because you need newer and better sectors to drive GDP rather than old war horses that people have been tracking for 20, 25, 30 years. The advent of Mr. Trump and this threat of sanctions across the world if you don't listen to him. Hirenji, how do you see this? How do you see the next 4 years panning out? If Mr. Trump were to make America great again, that would obviously mean that a lot of money that was invested in emerging markets would now find its way back to the US. And despite rising yields, US markets refuse to buckle. Is this something that we will see accelerating over the next 4 years? And does it mean more pain for India?
Um, so there are two things, right? I mean, I think very clearly for Mr. Trump, he's laid out his priorities. He wants more and more investments to happen in America, right? Now, the question, therefore, is that will that mean that there is lower FDI coming into India, right? I think, uh, you know, I would not like to extend this argument too far into the future and say कि next 4 years no investments will come into emerging markets and everybody will only invest in America, right? I think a lot of the Trump policies are to really get a lot of the countries onto the negotiating table. For example, there was a lot of fear that immediately on coming he would increase tariffs on China. But you have seen that he has actually not done that, frankly. So, what a lot of politicians say and what they finally do when they sit in the seat of power, because they also, you have to understand, have to manage a lot of practical things on the ground, right? So I believe that India's attractiveness is also because India is a large market. Where else will you find 1.4 billion people and with rising incomes? Obviously, India will become a force to reckon with. So I am not of the belief that, just because Trump is going to attract investments in America, no investments will come or happen in any other part of the world. In fact, I am happy if a large economy like the US grows, and there can always be second order, third order beneficiaries. You know, if somebody is putting up a large facility in the US, maybe he needs help with technology. And today you can't do any capex without automation, without software. And maybe there could be a spill on benefit that may actually come. Or you may do end manufacturing in the US, but you may buy components from somebody in India, right? The key here is that whether you are competitive in what you are doing. If we are competitive and there is investments happening in any part of the world, you have a great opportunity for becoming a part of their supply chain. And that is going to happen. And it's all very easy to say, but if you don't have immigration and if you don't have skilled workers, how are you going to set up manufacturing capacity in the US? So I think today, you know, everybody is trying to take a lot of things very literally. We don't know how things pan out. Um, and yes, what Trump is trying to do has created a lot of uncertainty in the minds of investors and business people. But my sense is that all of this will settle down in some time or the other. And, I'm not as pessimistic about what Trump is likely to do. I think Indian entrepreneurs are very smart, Indian companies are very smart. They will figure out a way of benefiting from wherever there is a growth opportunity, whether there is exports or otherwise. So I think we need to be a little more patient. I think there'll be more clarity over the next couple of months which way the US is going. But I am not bearish at all that because, Trump is going to do everything that is great for America, it can happen at the cost of other economies. I think the world is still fairly interconnected.
Well, let's hope that rings true, and of course it will, given the last 34 years that you've spent researching all parts of the world, including India. My final question to you, Hirenji, is this, growing body of evidence, I don't know whether it's true or not, whether, this rising SIP inflow has given our foreign friends a very easy exit at the cost of the retail investor. We've also seen this data over the last 15-20 years is that when 1 year returns sort of contracts, the SIP values start to get lower and lower. So for now, retail investors might be enthusiastic buying the dip in the market, but once returns collapse over a medium term period, they stop the SIPs. Which side of the equation do you stand in this debate?
Well, I think, look, it's never completely on this way or that way, right? I mean, if there may be a set of investors who may feel discouraged to continue their SIPs if let's say 1 year or 2 year returns may be bad. But if you really look at and understand why in the first place have SIPs been so successful, it's because I think of the great work that mutual funds and the various stakeholders in the capital markets have explained to the general investing public that look, you need to systematically invest in this equities as an asset class. Markets can be volatile. There will be good times and bad times. And actually, this is to protect you from bad times, that if you systematically keep investing when the markets are bad, you know that's a great disciplined way of investing. So I don't think too often we have tried to guess कि क्या हो जाएगा, if these SIPs stop. I don't think that's going to happen. Yes, there can always be a percentage of SIPs which may halt if near-term returns are not that great. But I think the very appeal of the SIPs is that it is exactly to take advantage of these kind of market conditions where you are systematically investing rather than, stressing about, weekly and monthly and yearly fluctuations quite evident in the market. So I think that's the very appeal and the basis of why everybody wants to invest every month systematically, not getting flustered by what's happening in the marketplace. Now, can 10-15% of the SIPs stop? Yeah, they can stop. But I also believe that there are still, untapped investors. SEBI is now talking about micro SIPs as small as 250 rupees, per SIP. So there is a greater and greater thrust to go deeper and penetrate deeper into India and Bharat, just like what the FMCG companies did by sachetizing their products. I think we are now sachetizing investment products, right? Taking a SIP which is as low as 250 rupees to the smallest towns and villages of India, so that we can attract more. I mean, the structural move of financialization of savings is not going to change. We all sitting in Bombay may think whatever we want to, but I don't think that this structural trend, which has started a couple of years ago, is going to end in any abrupt manner. This will only strengthen. There will be peaks and troughs. There will be a percentage of SIPs which may stop, but I think there is much more to go. So I'm not, or as they always say, कि मार्केट में हमेशा कोई बायर होता है, कोई सेलर होता है,
जी.
right? For every seller that and I'm not saying that FIIs should continue to sell or anything. Every investor is welcome, but nobody sits and says कि मैं इसको exit नहीं दूंगा, इसलिए मैं अभी invest नहीं करूंगा, मैं उसको easy exit क्यों दूं, right? These are all just figments of our imagination. जो
Exactly.
इन्वेस्ट करता है वो सोच समझ के अपने हिसाब से इन्वेस्ट करता है. जो बेच रहा है, आई एम ऑल्सो होपिंग कि वो सोच समझ के बेच रहा है. I think this is a structural trend in India. This is not likely to reverse in any meaningful manner, in my view.
Right, Hirenji, I could have carried this conversation forward for hours together, but both of us are bound by time, you more than me. But the gist of this wonderful 35-minute conversation has been is that Hirenji feels that there is more fear in the market than rationality when it comes to sales. Most of the news, bad news seems to be blown up significantly, and we are now reaching a stage where there is more fear than rationality. And of course, good news coming in hopefully from the government post the budget in terms of easing liquidity, and the fact that large NBFCs and capex oriented companies could provide that extra kicker in your portfolio from now on. Thank you so much, Hirenji. Here's wishing you a great year ahead.
Thank you. It was a pleasure talking to you again.
Right, sir. And we hope that you'll be back with us post the budget speech. Thank you so much for your time.
Bye-bye. Thank you.
Bye-bye. Bye. That, ladies and gentlemen, was Mr. Hiren Ved, Director and Co-founder, CIO at Alchemy Capital, one of the finest brains on the Lal Street. and I hope you enjoyed the conversation as much as I did. Please listen to it again and again to find out nuances in long-term investing and how to ride this volatility that is upon us. Thank you for joining us.
Watching Royal Ranthambore presents BT Golf. I'm Sakshi Batra, and with me is Dr. G. Munjal. He's from the Int Swift Laboratories. He's the MD and CEO. Warm welcome to you, sir. Thank you so much.